Northwestern Mutual asked thousands of working Americans one question in 2026: how much money do you actually need to retire comfortably? The answer came back at $1.46 million dollars. That's up $200,000 from just last year. If you're 52 right now, that increase happened while you were still trying to catch up on the number before it. Here's the part most people in their 40s and 50s get wrong. They have a 401k, that's their employer retirement account. They contribute every paycheck. They assume steady effort adds up to enough, but the actual median balance for someone in their 50s right now is $460,000. That's less than a third of the target, with far less runway left to close it than the 25-year-old two cubicles over. So, what actually closes a gap that size when you don't have 30 years left to do it? The answer has nothing to do with a bigger paycheck. It's a mechanism most people ignore because it looks too small to matter. That's what this video is about. Ignore it, and that gap doesn't shrink. It just keeps compounding against you instead of for you. My name is Alex, and if you've ever looked at your retirement account and felt the math stopped adding up somewhere along the way, stay with me. I'm going to show you the real math behind $25 a week and exactly where you stand against the number you actually need. Once you understand this mechanism, you stop guessing about retirement and start running the numbers yourself. That $1.46 million target didn't appear out of nowhere. It traces back to a much smaller number, one most people write off as too small to matter. The number everyone's avoiding. A woman named Renee Castellano found out how far behind she was on a Tuesday afternoon, standing in a hospital break room, looking at a number on her phone that made her sit down. Renee is 53. She manages a surgical unit at a hospital outside Cleveland, Ohio. She makes $92,000 a year. She has contributed to her 401k, that's her employer retirement account, every single paycheck since she was 26. By most standards, Renee has done everything right. So she ran the numbers that afternoon out of curiosity more than worry. She wanted to see how close she was to the $1.46 million retirement target we just talked about. Her balance came back at $380,000. That is actually above the current median for someone her age, which sits at $460,000 for people in their 50s overall, and well above where most single earners land. And it is still less than a third of what she actually needs. Here's what makes this land differently for someone Renee's age instead of someone in their 20s. A 25-year-old with a shortfall has 40 years to fix it. Renee has somewhere between 12 and 14. The compounding math that once had decades to work quietly in the background now has to work a lot faster, with a lot less time to recover from a bad year. Now, you might be thinking, well, Renee just needs to save more aggressively. And sure, that helps, but here's the part that trips people up. The gap Renee is looking at isn't really a savings problem, it's a rate problem. The difference between money that sits and money that compounds is not small once you're this close to the finish line. Take her coworker in the same unit, a respiratory therapist who just leased a 2026 Range Rover Sport HSE for $1,100 a month. Over 3 years, that's roughly $40,000 spent on something that will be worth about half that by the time the lease ends. That same $1,100 a month invested instead at a historical 10% average return becomes roughly $46,000 in just 3 years. Stretch that same monthly amount to 15 years and it becomes over $400,000. Same money. Completely different direction. That's not a judgment on the car. It's a look at where the actual leverage in Renee's situation is sitting, mostly unused. This is the uncomfortable part nobody says out loud at your annual benefits meeting. You can do everything your financial advisor told you to do at 25 and still be $750,000 short at 53 simply because of what inflation and stalled growth did to the plan while you weren't watching closely enough. So the real question isn't whether Renee is behind. She is, and so are most people her age. The real question is what's actually been quietly eating the difference between what she saved and what she needed. And that answer starts with a number that's been rising faster than most people's paychecks. Why the paycheck isn't the problem. That number is inflation, and right now it's running hotter than it has in 3 years. The latest reading puts the consumer price index at 4.2% over the past 12 months. That's the highest it's been since 2023. And if you only look at that headline number, it almost sounds manageable. 4% doesn't sound like a crisis, but headline inflation is an average, and averages hide where the pain actually lands. Break it down by category, and the picture changes fast. Energy costs are up over 20% year over year, driven mostly by gas prices, which have climbed more than 40%. Shelter costs, that's rent and housing, are up around 3.5%. Groceries are climbing again, too. These aren't optional line items you can just cut. You can skip a vacation. You cannot skip your mortgage payment or your commute to work. Take a man named Doug Prentice. Doug is 56. He's a facilities director for a school district in Columbus, Ohio, making $78,000 a year. Doug got a 3% raise this year, which felt like good news until he actually sat down with his budget. His health insurance premium went up 11%. His homeowner's insurance went up 9%, part of a nationwide trend as insurers price in more climate risk. And when his adjustable rate mortgage reset this spring, his payment jumped because average rates are sitting above 6.5%, the highest they've been in years, added up, and Doug's raise didn't put him ahead. It didn't even keep him even. He is, in real terms, poorer than he was last year, despite doing the one thing everybody tells you to do, which is ask for more money. Now, here's where it gets strange. Doug's neighbor just bought his wife a Cartier Love bracelet, the yellow gold version, retail around $7,200 to celebrate paying off their car. And nice gesture. But that same $7,200 sitting in a regular savings account instead would have lost roughly $300 of purchasing power this year alone, just from inflation eating away at it while it sat there earning almost nothing. That's the part that should bother you. Money that isn't actively working against inflation is losing a quiet, invisible war every single day it sits still. You don't feel it happen. There's no notification on your banking app that says, you just got a little poor. It just happens month after month until one day the math doesn't add up and you can't figure out why. So if raises aren't solving it and cash savings are actively losing ground, what does that leave you with? Because at this point, sitting still isn't a neutral choice. It's a decision, and it has a cost, whether you're the one making it on purpose or not. That's the real starting point. Not how much you earn, what you do with the part you don't spend, and whether it's working as hard as you are. The mechanism, what $25 actually becomes. A machinist named Walt Bergstrom once told me he ignored his retirement account for 11 years because $8 a day felt too small to matter. He was wrong, and the math proves exactly how wrong. Let's walk through it slowly because this is the part people skim past, and it's the part that actually explains everything. $25 a week comes out to about $108 a month. Put that into an index fund tracking the broader US stock market, which has historically averaged around 10% a year. And here's what happens. After year one, you've put in $1,300. Your balance is $1,361. That extra $61 is the market, not you. It's small. It's almost forgettable. This is the part where most people give up because nothing about $61 feels like a retirement plan. But keep going. By year three, you've contributed $3,900. Your balance is $4,527. The gap between what you put in and what you have is widening quietly in the background while you're doing absolutely nothing differently. By year five, you've contributed $6,500. Your balance is $8,389. Now, the growth is starting to outpace what you're actually putting in yourself. Jump to year 10. You've contributed $13,000 total. Your balance is $22,193. Read that again. You put in $13,000. You have $22,000. $9,000 of that showed up without you doing a single extra thing. Now, here's where it gets strange because the next 10 years don't behave like the first 10. By year 20, you've contributed $26,000. Your balance is $82,285. $56,000 of that is growth alone, more than double what you actually paid in. And by year 30, your contributions total $39,000. Your balance is $244,800. You put in $39,000 across 3 decades. the market handed you $206,000 for doing nothing but leaving it alone. Now you're probably thinking, sure, but who has 30 years left? And that's fair, especially after what we just talked about with Renee and Doug. But watch what happens at year 20 instead, since that's the more realistic window for a lot of people watching this. $82,000 on $26,000 contributed. That's not nothing. That's real money doing real work off a habit smaller than most people's car payment. Speaking of car payments, consider a physical therapist named Colette Ashby, who financed a 2026 BMW X5 X-Drive 40i at $790 a month. Over 20 years, that same $790 a month invested instead at that same 10% average becomes just over $600,000. The car will be in a junkyard by then. The money would still be working. That's the actual mechanism. Not a hack, not a secret, just math that rewards patience and punishes waiting. The question stops being whether this works. It obviously does. The real question is where you actually put it, because not every fund and not every fee structure gets you to that number. The 5-fund, 0-fee blueprint. A dental hygienist named Priya Anand once asked me why anyone would bother picking 5 different funds when one would technically do the job. Fair question. Here's the honest answer. You could put every dollar into a single US stock fund and be fine most years, but most years isn't the same as the year you're actually counting on. At 50-something with 12 to 20 years left before you need this money, a single bad stretch in the market hits differently than it did at 25. You don't have 40 years to wait it out. So the goal isn't just growth anymore. It's growth that won't wipe you out right before you need it. That's where the blueprint changes. Fidelity currently offers a handful of index funds with a 0% expense ratio, meaning you pay nothing in fees to hold them. FZROX gives you the entire US stock market in one fund, thousands of companies large and small. FZILX does the same thing for international markets, so you're not entirely dependent on the US economy alone. FNILX tracks the large established companies that make up most of the S&P 500, and FZIPX rounds it out with the small and mid-sized companies that often grow the fastest and also fall the hardest. 4 funds, 0 fees, and genuine diversification. That's already better than what most people are holding without realizing it. But here's where it gets strange for someone in their 50s specifically. The 5th fund isn't a stock fund at all. It's FXNAX, Fidelity's US bond index fund, currently yielding a little over 3.5%. Bonds don't grow as stocks do. That's the point. They're there to cushion the portfolio when stocks drop. So a market crash 5 years before you retire doesn't force you to sell at the worst possible moment. Think about it like this. A commercial pilot named Desmond Okafor spent $42,000 on a Rolex Submariner, reference 12460, the year he turned 50. Beautiful watch. It does exactly one thing, and it does it well. It tells time. Your portfolio at this age needs to do 2 things at once: grow your money and protect it from a bad year at exactly the wrong moment. One fund can't do both. 5. Working together can. Now you're probably thinking, doesn't adding bonds just slow everything down? A little, yes. But slower and still standing beats faster and wiped out, especially when you're this close to needing the money for real life instead of theory. So the actual move here isn't complicated. Open a brokerage account, split your weekly contribution across these 5 funds, and let each one do its specific job. No stock picking, no guessing which company wins next year, just broad ownership of the market at 0 cost, waited for someone closer to the finish line than the starting block. And once the money's actually in the right place, the next question becomes obvious. How far behind is the average person your age really compared to where you'd need to be? Where you actually stand right now. A pharmacist named Todd Whitfield told me he assumed he was ahead of most people his age. He wasn't wrong exactly. He was just measuring against the wrong number. Here's the actual data, and it's worth sitting with for a second. For people in their 40s right now, the average retirement balance is $593,000. Sounds decent, right? But the median, meaning the middle of the pack, the number that actually represents a typical person, instead of getting pulled up by a few huge accounts, sits at $220,000. That's the gap between what sounds normal and what's actually normal. For people in their 50s, the average climbs to just over $1 million. The median is $460,000. Less than a third of that $1.46 million target we opened with. And here's the number that really puts it in perspective. Across all four 01k accounts at Fidelity and Vanguard combined, the median balance right now is around $44,000, not per decade, total. That's not a retirement plan. That's barely a down payment on one. So why the massive difference between average and median? Because a small slice of high earners with maxed out accounts for 20 straight years pull the average way up, while most people are somewhere well below it, quietly assuming they're roughly on track because nobody ever shows them the real spread. Todd's situation makes this concrete. He's 49, makes $96,000 a year, and has $260,000 saved. That actually puts him slightly above the median for his age group, and he's still over $1 million short of the target. Being ahead of average and being on track are two completely different things, and almost nobody tells you that until it's late enough to sting. Now, you might be thinking, well, the target itself might be inflated, some marketing number designed to scare people into buying an annuity. Fair skepticism. But even if you cut that $1.46 million number by a third to be conservative, most people in their 40s and 50s are still six figures behind, and the gap gets harder to close every year it's ignored. Here's where it gets strange, though. Todd's brother-in-law just put a deposit on a waterfront listing in Sarasota's Bird Key neighborhood, asking price around $3.2 million as what he called his retirement plan. Real estate can absolutely build wealth. But a single illiquid asset in one location exposed to one local market and one set of property taxes isn't the same thing as a diversified retirement account you can actually draw from flexibly at 65. So if you're looking at your own number right now and feeling that same gut drop Todd felt, that's actually useful information, not a reason to panic. Knowing exactly where you stand against the real target is the first honest step most people skip entirely. The dangerous number isn't the one you're behind by, it's the one you never bothered to check, which brings up the real risk in all of this, the one that has nothing to do with how much you've saved and everything to do with what you do the next time the market drops. The behavioral trap that erases all of it. A retired airline mechanic named Gordon Reyes sold his entire portfolio at the bottom this spring out of pure panic and locked in a loss he'll likely never fully recover from. He wasn't reckless, he was scared, and scared makes people do the worst possible thing at the worst possible time. Here's what actually happened. Earlier this year, the conflict with Iran triggered a real oil shock. Energy costs jumped over 20% in a matter of months. Gas prices spiked more than 40%. That kind of headline doesn't stay contained to gas stations. It rattles markets, and markets full of scared people don't behave rationally. They behave like a crowd. Think about a school of fish for a second, like thousands of them moving as one. When something startles the fish at the edge, the whole school turns instantly, not because every fish individually decided that was the smart move, but because panic spreads faster than analysis ever can. The stock market works almost exactly the same way. A crash isn't really the market malfunctioning, it's millions of individual people reacting to fear at the same time and reinforcing each other's fear as they go. Gordon watched his balance drop, felt his stomach turn, and pulled everything into cash. Here's the problem with that decision, and it's the same problem every time. The loss wasn't real until he sold. Before that, it was just a number on a screen, temporary on paper. The moment he sold, he converted a temporary dip into a permanent loss. He didn't just lose money. He broke the compounding chain we spent this whole video building, and he reset his own clock right when he had the least time left to rebuild it. And here's the part that should really bother you. Markets that get hit by shocks like this one have, historically, always recovered and gone on to reach new highs afterward. Always. Not most of the time, every single time, given enough patience. The people who lose money in a crash aren't usually the ones who stayed in. They're the ones who got out and never got back in at the right moment because nobody rings a bell to tell you when the recovery starts. Compare that to a wealth manager I know who did the opposite. Same volatile spring, same scary headlines. She kept contributing on schedule, didn't touch a thing, and instead used the dip to buy a Chanel classic flat bag in caviar leather for $8,800 because prices on stocks were down and prices on handbags, notably, were not. Small joke, but the point underneath it is serious. She treated the crash as noise, not as a signal to abandon the plan. So if you're 52 right now and thinking a downturn feels a lot scarier this close to retirement than it did at 30, that instinct is understandable, but it's also exactly the instinct that costs people the most money, right when they can least afford to make that mistake, which leaves one real question left to answer. If the math works and the behavior is the actual risk, what do you do with all of this starting today? The habits that outruns the number. So here's the actual realization underneath everything we just walked through. You were never behind because you made bad decisions. You were behind because nobody showed you the real target or the real math until now. A few things worth holding on to. Compounding doesn't care how old you are, only how long you leave it alone. A raise that doesn't beat inflation isn't progress, it's standing still with extra steps. The gap between average and median savings is the gap between what sounds normal and what actually is. And the single biggest threat to your money was never the market, it was ever pulling it out in fear. So look at your own accounts this week. Not to panic, just to know the real number, the way Todd finally did. There's one thing we didn't get into here, and it matters just as much as the funds themselves. What happens to all of this the day you actually retire and start pulling money out instead of putting it in? That's worth its own conversation. For now, tell me in the comments where your number actually landed. If this helped, share it with someone still guessing instead of checking.